Welcome to today's episode of Slash Tax, where we uncover smart strategies to slash your tax bill, unlock incentives, and invest strategically to build wealth. I am your host, Heidi Henderson. And before we dive in, I have a really exciting announcement. If you're listening on Spotify, all of our future episodes will also be available to watch right on the app. So make sure that you hit subscribe so you don't miss out on the conversations and the insights that we'll be sharing every single week. And today, my guest is Adam Carver, who is the CEO of SunSaver Tax Equity and Tax Credits. Adam and his team help corporations, high net worth individuals, and family offices mitigate 10 to 25% of their federal tax liability by leveraging clean energy tax credits. This will be an interesting topic. What
Mhm.
makes SunSaver unique is their ability to create tailored portfolios and white labeled programs that empower tax directors and CPAs and wealth advisors to offer cutting edge solutions to their clients, as well as our accredited investors. So, Adam's background in venture capital and fintech includes raising capital for blockchain and AI and sustainability driven investments, giving him a powerful perspective on both technology and tax strategy. At SunSaver, he combines advanced software with strategic partnerships to make renewable energy tax credits not just an environmental investment, but a smart financial one. So, in this episode, these are some of the questions I have for you. We're going to discuss how how these tax equity strategies work, when the timing of investments matter, because on this episode, recording towards the end of the year, um, the returns that most investors might expect, or kind of how these are structured, and then how these credits interact with rules on passive activity and ordinary income. So, kind of deep, kind of technical topics, but this is what a lot of our listeners here on the podcast are looking for. And we're like, you know what? Let's just get into it. So, with that,
Surface
Adam,
level, no surface level. Let's dive in.
that's exactly right. So, welcome to the show.
It's great to be here. Thanks for inviting me, Heidi. And how are you doing after the tax deadline?
Oh, this is great timing. This is the week after September 15th. It was the week of September 15th. We survived one of the biggest tax deadlines of the year for us, particularly after the one big beautiful bill, which
Hmm.
we can talk about because I know that that was something that was potentially something that could dramatically impact your business. And so I'd love to kind of dive into that as well. But yeah, here we go. So now the whole game is like we've finished 2024 tax filing.
Right, right.
Now on to 2025 tax planning and strategy. And it's all shifting into what do we do before the end of the year?
That's
And that
right.
leads us to you.
All right.
So let's hear it. Tell us a little bit about what your focus is. And, let's
Perfect.
start with your background. Like, share a little bit of what got you here, first off.
That's great. So I began my career in structured finance. I worked for the Royal Bank of Scotland and in the Morgan Stanley Structured Products Group for many years throughout the 2000s, and then decided that I wanted to get into renewable energy investment banking and investments. I went to the University of Michigan and completed a master's in science and an MBA in energy systems. It was a combined program.
Wow.
Then I didn't do anything with that degree for the next decade. I discovered venture capital and was entranced by early stage technology investing. So I became a VC here in New York and then raised a small venture capital fund myself, which is still in operation, although I'm not operating there any longer. And then I uh, moved from venture capital and transitioned to the operating side. I worked for a company named AngelList. Some of your clients may be very familiar with that angel investing platform.
Oh,
And
yeah.
in 2018, 2019, became enamored by blockchain and distributed networks. Left AngelList and began building tools using blockchain and distributed ledgers. And sometime in 2021, I began thinking about how we could create liquidity in environmental markets. Some engineer friends and I began researching ways to invest into renewable energy projects. And
Okay.
that ultimately led to what we're going to discuss today, which is an extremely effective and yet seldomly understood strategy for providing project finance for renewable energy investments that simultaneously mitigates the tax burden for U.S. institutions and high net worth individuals. And there's this beautiful marriage of tax mitigation plus renewable energy investing and renewable energy generation that I found so compelling at the time that in early to mid 2022, when my team discovered this and then also recognized that it is so seldomly understood by private wealth managers and many accountants, we
Hmm.
decided that it was a product unto itself and pivoted from everything that we were previously doing and started from scratch to build this platform that we now call SunSaver.
Amazing. That is a pretty crazy background. And wild that you've been in all these different areas and blockchain and AI. I feel like we could do a whole nother podcast on all of that. Um, and I would be completely behind the eight ball because those are things that I still struggle to grasp or wrap my head around. Um, but for today, we're going to try to wrap our heads around this whole concept of investing in renewable energy and then how this is structured. So let's dive into that as I guess gently as possible as to how does this actually work as an investment?
It's ironic that you say that you're behind the eight ball with blockchain, but many folks feel that way about the tax code. So what we're trying to
Totally.
do here is to demystify what are sound structures where there's guidance from the US Treasury for decades and make these investment opportunities or these strategies available and accessible to your listeners. So let's start with what is the problem that we're trying to solve with these tax credits and these tax equity structures? Well, fundamentally, it's very likely that many of the listeners on your podcast, are overpaying the IRS. And
Hmm.
they're overpaying not by a mere few basis points or 1 or 2%, but for those who are eligible to utilize these tax credits, they're potentially overpaying by 5, 10%, or potentially even 15%. And it's not their fault. And it's not necessarily the fault of their tax accountants. There have been significant changes in the past 2.5 years, and as recently as July 4th of 2025 with the Big Beautiful Bill, that have created these opportunities and made them more accessible for US institutions and individuals.
Hmm.
At the heart of this strategy is a tax credit, or clean energy tax credits. And a tax credit is, it's not a security, but it is a dollar for dollar offset against your tax liability. For decades, the IRS has allowed renewable energy developers, so builders, tax credits when they install new renewable energy infrastructure. Effectively, the tax credit is an inducement for investors and developers to build more renewable energy infrastructure. And this
Hmm.
program was expanded by the Inflation Reduction Act in late 2022, and it was first implemented in 2023.
Okay.
So
So
it's
just
still,
quickly on when we define renewable energy, are we specifically talking about like solar projects or is this other types of projects as well?
there are about approximately 15 different technologies that these credits apply to.
Oh.
And there is a specific tax credit that is called the Section 48E or 48Y, which is a technology neutral credit, which spans wind, solar, geothermal, heat pumps, actually small nuclear generation. There's a credit for carbon capture, carbon sequestration.
Hmm.
So we are talking specifically about the renewable energy credit, but that spans, again, that applies to many different technologies. And in order to use the credit, the we'll call them the investor, but they are the tax account. The taxpayer does not need to be the owner of the physical asset. And that is one of the innovations of the Inflation Reduction Act, is that it enabled individual tax accounts to purchase and utilize these credits and then enjoy the benefits of harvesting the tax mitigation without physically owning the asset. They can
Wow.
simply purchase the tax credit off of the primary market directly from the sponsor or the renewable energy developer.
Okay. So when we're talking about purchasing credits, what is typically the best application for that when I talk about the user? Like who's the ideal? I know there's a lot of institutions that can do this, and I'm curious as to what you're seeing in terms of how that's utilized at, like, say, the institutional level. And then let's kind of also track that down to how that applies to, what I would call just normal people.
Right, right. Us.
Yes, yes.
The rules are fairly strict pertaining to which tax accounts are qualified to use these tax credits.
Mm-hmm.
At the very top are C corporations. C
Okay.
corporations, particularly public companies, can purchase the credits or the depreciation that also comes from these assets. We can discuss that in a moment. And immediately apply that to their federal tax liability. For example, you would buy a credit that's worth $1 in tax offset. If you were to purchase that for 90 cents, then you would immediately recognize a 10% tax mitigation. If you buy
Okay.
for 95 cents, you recognize a 5% tax mitigation. When the user is not a C corporation, let's say it's an individual, it could be a high net worth individual, family office, or disregarded entity such as an LLC. That individual or the tax liability that is being offset must be passive. And
Mm.
typically you find this passive income on K1s. A
Yeah.
passive investment, by definition, is when you own a thing, but you don't work there full time, which is kind of defined as 500 hours a year or so as a material participant in that activity. So if you're an owner of a thing, you're an investor, but you don't work there, and yet you're receiving dividends or some cash benefit, that's passive. Really, the bullseye for passive investments are real estate, leasing businesses, advertising, such as advertising billboards. But if you owned a share of a restaurant, you weren't working at the restaurant, and the restaurant was paying you a dividend, that's a passive investment. And your passive income, which will probably be captured on a K1, can be offset with these tax credits. Simply. However, many of us have income that emanates not from a passive activity, but from an active activity. W-2 income, for example,
Hmm.
1099, or your portfolio income, like the sale of capital gains, basically the sale of stocks or collecting interest from bonds.
Or like
Wow,
like stock options and things like that. We have quite a few
exactly,
investors who have
exactly.
like a
It
stock option
actually
buyout or
that's
something.
kind of a strange definition. There's an overlap in that definition because it is passive, but there's an
Yeah.
exception for
Yeah.
portfolio gains, right? Portfolio gains are not passive in the sense of qualifying for the tax credits. However, they're for this third category of people with active W-2 income or 1099 or portfolio. For example, not only are these high net worth individuals, very often they may be general partners at private equity funds, limited partners, um, folks who work in finance, or they may be some type of founder who is selling their company or an early employee at a company that is experiencing a liquidity event. There is a third qualification that's known as the 100 hours test, and you're familiar with this,
Yep.
states that an individual can utilize tax credits to offset their W-2 tax liability or portfolio capital gains liability if they contribute or work 100 hours in a calendar year in the activity that generated the tax credits. So in this scenario, that would be 100 hours of work at any point from January 1st until December 31st, supporting or operating and managing the renewable energy assets that produced the tax offset, the credits
Okay.
themselves and the depreciation. Now that
So
work can
it's
be done remotely. Some work, what counts as work? Online education, remote, it can be remote work, customer support tickets, working with the developers, the general contractor, collecting payments from the off-taker, attending conferences as well, site visits. So
hmm,
there are some tax attorneys and tax accountants who set up this 100 hours protocol on behalf of their clients. And it tends to be very bespoke because it
mhm.
is relative to the specific asset, a solar farm, wind, geothermal, what have you, that is generating the credits.
So interesting. So for listeners, I deal with a lot of real estate stuff, a lot of real estate investors. We have talked a lot about that on previous episodes of this podcast as well. And passive versus active is something that's talked about in a lot of different episodes, including this one. But this is so unique because rather than this being about real estate participation with rental property,
Mhm.
we deal on the real estate side a lot with the whole short-term rental loophole, which then links to this 100-hour rule because it is considered a business function,
That's right.
not actual real estate. It's very similar to the short-term rental loophole, but in this case, it is essentially the same. You are working towards material participation, being active in the business activities as it relates to this renewable energy project. Okay, now that we understand that, let's pull it again around and go, okay, but wait a second. How the heck does that work? If I invest in some solar project, how do I have any involvement in this thing?
It's by the way, that's a great point, and I loved hearing that you've already covered the passive active as well as the 100 hours on your podcast. This is not incidental that these similarities and coincidences have cropped up because
Hmm.
the Inflation Reduction Act effectively borrowed the language from real estate investing.
Oh, I didn't know that.
Yes, like this, that is the origin, why there are such familiarity and likeness between the renewable energy tax credit and real estate is because the solar or the renewable energy ITC, the investment tax credit production, originated from real estate.
Hmm.
So there's always going to be similarity if you're familiar with that former paradigm. So how could a user, how could a taxpayer, as an individual, let's call it engineer these 100 hours?
Hmm.
Well, it's not very easy, particularly if you're not an engineer or a technician who's going to build a project. What my company does, we specialize in building, owning, and operating portfolios of residential solar and battery storage properties.
Hmm.
So for an individual who has, let's say, $1 million of federal tax liability, and they need to engineer the 100 hours to become active in that portfolio and utilize the tax credits, we will set up a structure known as tax equity. And that
Okay.
is uh, featured in a limited liability company, so an asset holding company, where SunSaver, after we build these residential solar assets, we sell them into a limited liability company that is 99% owned by the individual taxpayer or their family office. And we retain a 1% management, 1% ownership as the managing member.
Hmm.
Those residential properties actually require a significant amount, a substantive amount of ongoing maintenance and operation because we're potentially dealing with 150 properties or perhaps 300 or 500 properties, depending on the tax demand or the tax liability that the individual has to offset.
Okay.
Roughly
So
speaking,
just really quick on like just backing up. So I'm wrapping my head around this whole idea. How are you finding these projects? I mean, are you involved with actually going out and building? Do you have a company that's installing solar panels? How do we get from this idea of, okay, I have this much tax liability. I want to invest in something that's a, good investment, can also help me reduce my tax so that I can kind of just keep that money and reinvest. This is kind of the whole concept we talk about on this podcast a lot. So in this situation, I can work with you at SunSaver and say, here's my situation. I want to kind of invest something so I can back into this and invest in this project. How exactly are you structuring? How do we get from that initial idea to
great.
actually
Let's
having
start
a
at the top.
solar?
We have the example of an individual or their family that has $1 million tax liability every year. And one of the beauties of this strategy is that you can repeat it each and every tax year. And you can do
Okay.
it throughout the tax year and then immediately offset your uh, quarterly estimated payments to the IRS. And
Hmm.
we can get there eventually. So
Okay.
there's a user who has $1 million of tax liability. they would connect with SunSaver through Heidi. And instead of paying $1 million to the IRS, which if you think of that in the framing of an investment, well, that has a negative 100% return on the investment.
Mm-hmm.
This scenario, instead of paying the IRS, you redirect some percentage of that liability toward new renewable energy projects. That's
Okay.
where we come in, right? We're the platform that will help to identify those projects. Typically for us, we're building in Texas and California, as well as Washington, D.C. And we work with local installers who identify the projects, design them, and then do the installation. That is
Okay.
the one aspect of the value chain that we don't participate in. We don't climb on
Mm-hmm.
roofs, but we work with trusted installers and then operations and management teams, the boots on the ground, who are actually knocking on doors, identifying homeowners, and then designing and installing their solar panels as well as their battery storage. Thereafter, those projects and their contracts are sold into this tax equity limited liability company that we set up on behalf of the investor, the taxpayer. And then those projects will be managed for their lifespan, which is 25
Okay.
years. That management is taken care of or is addressed by SunSaver and involves working with the homeowner customer to ensure that their banking information is always up to date. We withdraw monthly invoices from them on the 15th of every month. Occasionally, they change their bank account information. So we have an ops analyst who works with them to do so. We have an online portal where those homeowner customers can go to see the production of their systems, the storage of electricity in their battery, the amount of savings that they're receiving. And very often they have questions or a customer support ticket that may require us to dispatch a electrician or some type of technician. And all of those customer support tickets, that
Mm-hmm.
entire operations effort, which we will typically do on behalf of the tax equity investor, let's say if it's a C corporation or one of those passive investors that we were discussing, the real estate investor. In the case where the user requires the 100 hours, we allow them to triage those customer support tickets and those activities when they arrive. And all of this happens within a custom online portal that we've developed where that individual can log in any time of the week that they choose and answer customer support tickets. Again, they can also, we encourage them to visit the sites at least once or twice per year or attend conferences related to renewable energy or tax credits. There are a number of different activities that they can take that enable them to accumulate in excess of 100 hours. And one last point that's important is that the principal breadwinner in the family does not necessarily need to be the one to accumulate the hours. If that individual and their spouse are jointly filing, the spouse can also accumulate those hours. So the 100 hours
Okay.
must be a combination of those two adult taxpayers.
Got it. Yeah, that's great. That's a great point. Definitely a strategy. Also correlating to real estate. How it's like looking at
Right.
who
Right.
is involved with the property management or whatnot. Okay, I've gone through this with you a few times, and I still am always kind of trying to wrap my head around this. So
Right.
you're working with installers. Are you in essence then carrying the notes? The financing, are you like are you just managing managing the loans in terms of servicing them, or are you actually taking over and carrying the notes? Because I mean, let's just think about it as like myself. I've got guys banging down my door every day, and you should put solar panels on your house, and they're trying to sell you solar panels constantly, and they want to, look, no big deal. We'll do a 20-year note on this
Heidi,
thing, and
they're
it's the
working
same
for
as your
me.
power. It's like,
I told them like Bahamas vacation for whoever converts you as a customer.
yeah, yeah, exactly,
But that
exactly.
but that is true. When people are on Instagram, or
Uh-huh.
maybe somebody's knocking on their home, but when they're seeing advertisements on Instagram or Facebook or
Mm-hmm.
they're hearing free solar on Spotify, that's legitimate. That's what our
Yeah.
company does. We
Hmm.
offer free solar installation. So the installation and the equipment to homeowners, zero money
Mm-hmm.
down, and it is not a lease, nor is it a loan. At least my company does not participate in leasing. What happens is that SunSaver, we will finance and then build the project at no cost for the homeowner. We own the equipment for
Mm-hmm.
25 years. So the homeowner is
Oh,
allowing us to use their roof or some space in the garage for the battery. And the
okay.
homeowner is then purchasing solar electricity from us. And there's a net
Oh, okay.
discount.
I'm getting, I may be a little bit slow, Adam. I am like,
No, that's so, but there are many different products in this space. We specialize in
okay.
what's called a power purchase agreement. So we have an
Yes.
agreement with you, the homeowner, that
Mm-hmm.
say we're going to install $85,000 of solar equipment on your roof.
Mm-hmm.
That is not a sale, right? We're not offering you a loan or a lease where there's an interest rate, but rather we're going to install these panels and the battery on your house, zero money down, and then you're going to pay for the solar electricity that we generate from your roof.
Okay.
And any excess electricity that you don't use, we'll sell back into the grid on your behalf, and then you'll receive some credit from your utility. So that contract is a power purchase agreement, PPA.
Yep. Which, of
There,
course, I've heard of that. That's
right,
what a lot
right,
of solar
right.
installers are doing with the homeowner to sign a PPA with the local power company.
Yes.
But this is so interesting. Okay, so you're
So then
structuring this in
you
a
as
way
the
because,
homeowner have,
yeah,
right, you sign a PPA with SunSaver. It's branded as
wow,
SunSaver. And it
wow,
has my signature on there and it has your
hmm,
signature and the
hmm,
installer. Right. And it
got it.
states this is a 25-year contract.
Hmm,
There's going to be a fixed monthly amount that's withdrawn from your bank account every month. And depending on the production of the system, once a year we'll top up or we'll do a top off, right? So that everybody is even heading into the new year. After 25 years, if if there's no balance remaining on your account, we give you the equipment for free. Typically, after 15 or 20 years, somebody may want to replace their roof anyway. So you remove the equipment, place that in the garage, right? Replace the roof, and then we can replace the PVs and the battery, or we could sign you up as to a new contract as a homeowner. In the event that you sell your home, typically this question comes up. The new homeowner can elect for us to remove the system if, for
hmm.
whatever reason, they want to pay the utility more, or they can opt to continue the contract. And the contract is extremely lucrative. In the first year, we'll guarantee that there is at least a 25% savings on
Hmm,
the homeowner annual electricity bill. And there
okay.
is a small escalator each year, depending on your state and jurisdiction. Maybe that's 3% or 3.5%. But I
Hmm,
do put into our contract that it is the lesser of the escalator from the utility or 3 or 3.5%, because I feel that homeowners ought to have that put option. In California, PG&E raised rates by 10% last year. So if
yeah,
you think about that 10% escalator, even if it's 7% compounded over 10 years, 5 years out, 10 years out, the homeowners are saving significantly more than 25% per year. Anyway, so
yeah,
you have the
absolutely.
contract. There's a contract that SunSaver has with the homeowner. We then sell that contract into the asset holding company, which is 99% owned by the taxpayer or the user. And
Got it.
that's where this extremely odd coupling of terms, tax equity, gets
Yeah.
its name. It took us 30 minutes to get there, but it is not just the credit that you're buying,
Yeah.
but taxpayer is becoming an equity investor in these physical renewable energy assets through this
Yeah.
discarded entity, this LLC.
Okay.
And the benefit of being the equity holder is that they receive the tax credits plus
Hmm.
property depreciation, which is maybe a great segue now, plus
Yep.
some cash that is then generated on a quarterly basis from the sale of electricity to the homeowner. So it really is,
Hmm,
it's a phenomenal opportunity.
hmm,
Again, coming back to the idea of an investment, paying tax to the IRS is not an investment. And if it is, you lose 100% of it, guaranteed.
Yep,
This is an
exactly.
opportunity to redirect some of that capital that's already being lost
Mm.
toward solar projects or any renewable energy, but for the purposes of SunSaver, residential solar and storage projects that then generates up to 20 or 25% tax mitigation for the taxpayer.
Wow.
You would pay, let's say, $800,000 instead of $1 million. You would take 800,000, invest that, receive back $1 million worth of tax credits and property depreciation, which you would then claim in your tax filing to the IRS.
Yes. And if this is an equity partner who is in your investment and they're incurring the 100 hours using your platform and through whatever means you provide, I'm guessing it sounds like you provide some guidance on the tasks and things that would qualify, how to track that, then they would potentially apply that onto their personal tax return against all of their, including earned income, W-2 earned income.
Yeah, that's absolutely
Yeah.
correct. We knew and we know that many high net worth taxpayers are working with their tax accountants and tax attorneys to organize these bespoke 100 hours protocols.
Hmm.
We decided instead of using a handwritten journal or an Excel spreadsheet, we now have the technology to track and timestamp all of these activities.
Well,
And
and you maybe need to build the same technology for real estate because we're dealing with all the short-term rental people
this
asking,
this
how
sounds
do we
like the
track
birth
this?
of a beautiful
So
partnership.
there you go, Adam.
But it, but
We
it
have our
is.
next project, but I love you've already built it for here. So you have the technology built, which is
Yeah.
amazing.
So the idea is to create a digital audit log. And
Yeah.
it's not an advanced piece of technology, but
Hmm.
it is reliable. And it
Hmm.
is, the key here is that it's contemporaneous with the work and the activity that the user is performing. What we would never want to see in 5 years, if for whatever reason there is an IRS audit and the IRS sits down with the taxpayer at the kitchen table and said, I see that you spent an hour answering this email. What was the email about? Right?
Yeah.
Because it's in
Hmm.
your Excel spreadsheet. Instead, through our platform, because we are able to connect directly into all of these systems, right? Because the
Hmm.
batteries and the inverters, it's all online, it's all in the cloud.
Hmm.
So we can sign in, we, the investor, even you, we have logins for their tax attorneys and the tax accountants. So everyone can be on the same page. And for 24/7, you can see the sun is shining on this roof, or it's not, or it's cloudy, it's raining. One of 20 panels is out, or there's something up with this battery. Maybe we want to call the homeowner. Maybe we want to dispatch a truck because somebody needs to wash the panels because they're dusty, right? And that is, it's not rocket surgery by any
Yeah.
means,
Yeah.
but it is the operations of what we do day in and day out to manage large portfolios of residential projects. And
Wow.
somebody needs to do that ops work.
Yeah.
We triage that to the 100 hours user and we create a digital audit trail so
Mm.
that at any point somebody could point to an activity and say, I did that. And this was the
Got it.
impact.
Got it. It's so wild. Like, um, maybe listeners, if your wheels are turning, I'm sorry, even my wheels are turning, and this is a little bit of my wheelhouse, no pun intended.
You got it. You
But
did
the
it. You did
reason,
it.
yeah, exactly. Yes, it took us a half an hour to kind of get to the meat of it. But it is, I mean, it's the reason that I wanted to have you on here, the reason I wanted to have you on here right now, this time of year, as we move into the fourth quarter of the year before 12/31. This is the time of year that people start to say, what can I do? I know that I'm going to have a large tax liability. What are my options in terms of investing? And we have multiple things. We and I have talked again on this podcast about different oil and gas investments, real estate investing. There's a few different things. In all of those things, active versus passive is one of the biggest caveats to be aware of because your ability to apply tax deductions, tax credits, write-offs, or even investments and how it all boils down or crosses over onto your personal tax return ultimately depends on that. Is it active or is it
That's
passive?
right.
So I always feel like
Yeah.
I repeat myself on there, but this is one of the very few investment strategies that you actually could, it is relatively achievable to meet the active participation rules. So that is again why I really wanted Adam to come, especially this time of year, because I know people are going to be asking. This is the easiest thing for me to do is, hey, let's have a conversation, not to just share it. So I don't have to try to repeat myself
Yeah, if you
or
think
get
of
out.
it over the course of 50 weeks, it's 2 hours a week, but you don't
Mhm,
need to do 2 hours a week because you will perform some site visits, which I think
mhm,
it is mandatory if you're working with SunSaver. And my team will meet you there and we'll go visit some projects, take pictures, talk to the homeowner, ask how they're doing, meet the installer. We'll go to conferences. So there are opportunities to accumulate chunks along the way.
m'kay,
Doesn't need to be
m'kay.
every Sunday during HBO hour, but you should make these hours continuous.
Yep,
And the user needs to have some forethought. Obviously,
mhm,
it's now September 15th or in or around, and
yep,
it's going to be impossible to accumulate 100 hours in the month of December.
mhm,
So we're probably getting to a point where 100 hours becomes somewhat impractical unless a person is not working.
mhm,
But it is important to think about this going into 2026 so that you have 12 whole months and you don't need to rush toward the end of the year to try to accumulate those hours. And there's a good reason to do it early, not only because of the 100 hours,
mhm,
but the tax credits, of course, these are born from projects that are placed into service so they become commercially delivered in
mhm,
that given year. So December 31st is very significant because if you're investing in a project that is placed into service on January 1st, that cannot count against one's 2025 tax liability. So in
yep,
that way, there is a vintage to the credits, and that is a critical component. You have to use the credits or the depreciation loss against your tax liability from the same year. You can
mhm,
carry them forward 20 years in case you don't use them, but you can't carry them back easily. So you can't use a 2026 credit against a 2025 liability. So therefore, there is often right now a race in the industry. Every single tax credit is going to get purchased that
mhm.
originated from renewable energy projects between right now and April 15th.
Well,
Most of
yep,
them will be purchased by December 31st or January.
right, right,
There's a continuous race, and then the pricing of these credits gets
yeah,
higher and higher as there's greater and greater
mm,
scarcity.
yeah. Well, and I'm guessing for your team, I mean, to your point, these legitimately have to be installed. Now, I'm guessing you have projects just that are underway and in
We
progress.
warehouse
You're
we
sort of,
warehouse projects, but
yeah,
if you're
okay, because,
that's one of the benefits of doing residential solar
yeah,
is
mm-hmm,
that we can build projects all year long, warehouse them, and then
mm-hmm,
when a taxpayer shows up in October and they really are behind the eight ball, we can still satisfy that demand.
okay,
But once you get to commercial projects, those take 2 years. So you may
mm-hmm,
indicate that you want to be an investor in those projects in 2025, but if they're not commercially operable until 2027, that's a 2027 credit.
yep, that's a
I
great
would say
point.
the other now, some people may be asking, well, time value of money, do I want to do this in January and February?
Yeah,
The answer actually is yes, not only for the 100 hours, but also this is an advantage of the tax credit. The tax credit, even if the project is not yet built,
mm-hmm,
if there is an assumption, a reasonable assumption that the credit will be operable by December 31st of that year, the investor can utilize that credit against their quarterly estimated payments to the IRS.
oh, okay,
You can
okay.
use it in March, June, and September. And
So
that
rather
is
than looking at
another
refunds,
additional.
rather than paying tax throughout the year and then waiting to file
Right.
your tax return in March or April and getting your refund, you can actually look at your quarterly payments and then adjust those accordingly based on your projected tax credits or
Yeah. So
deductions.
so now think about it. Now think about that. In that scenario, there is no holding period on the credits.
What does that mean?
Typically, you invest money into an investment and then you have to
Hmm.
wait, right? And then you have
Mm,
a IRR calculation. In this
yeah.
case, the day that you make the investment into
Hmm.
that asset holding company, you can monetize or claim those credits. Now, if
Mm,
the projects are never installed, the IRS will likely come back and then recapture the credits, and you'll have a liability.
yeah.
But in practice, it probably won't happen for residential since we have the entire year, right? And
Yeah.
we don't ask for payment at
Wow.
SunSaver
Yeah,
until the
that's
projects are built.
a yeah, I mean, that's a huge point. That's not one that I was aware of. I think that I thought about being able to reduce quarterly payments because that's an immediate cash benefit ultimately. So instead of, again, paying the IRS that they could be holding for anywhere from 3, 6, 9 months holding your money, that's
Right.
great to get a
So there's a
refund.
time
But
value.
imagine
There's a time
what is your
value.
time value of money over that year that you could have
Correct.
had that
Correct.
invested in
Correct.
in
No,
income
you can
producing
monetize that credit
activities or
immediately. So that's
yeah,
technically an infinite IRR. Even though
yeah.
I try not to frame this as an investment because you're losing the money to the IRS anyway. But if you think of it in terms of, I invest $1 today, and then how long does it take for me to get that dollar back? You get that dollar back today plus,
Yeah,
right? You'll
right,
get back a
right.
dollar
Really
five
cool.
today.
Really cool. Okay. I know we dove into it. We got into the meat, but I want to circle back again and we're going to simplify this in like a real world example. And
Right.
I also understand this is huge for any of our large corporations, family offices, our big groups. We've got some of those big investors. I do want to actually focus this on some of our more regular investors, accredited investors. So, can we use the example of a taxpayer? Let's say we've got $1 million of income we've incurred or we anticipate we're going to have to pay $500,000 in taxes. And I guess first I should ask if you have any limits to a minimum investment in your program. But if not, can we use that example and can you kind of pencil out the numbers for me?
Sure. The statutes don't state a minimum, which is nice.
Okay.
However, I would say there is some practicality. If you have a liability of $50,000 to the IRS, to the extent that you have to perform 100 hours or let's say 110 to create a buffer or 120, what is your time worth?
Yes.
So I would recommend that this structure, just the 100 hours, right? Assuming
Mm-hmm. Mm-hmm.
non-passive. But if you have 100,000 in passive, then no problem. There's no minimum.
Yeah.
It's probably around $400,000 plus or minus
Mm-hmm.
400 to,
Mm-hmm.
to 500.
Okay.
I in fact have a small spreadsheet that I put together if you'd like me to share.
Yeah, oh, I think that would be great. Yeah.
Why
Yeah.
not?
I
We'll
can
do this
link
for
out
free.
some of those resources or in the show notes, we'll link that out and have people request that. And I'll be happy to share it with me. And then I'll be able to
That's
share the
great.
spreadsheet if people want to do the calculation. But let's use that example. We've got someone with $1 million of income. Let's assume $500,000 in income tax. What would be a potential investment? Would it be an investment of 500,000 that they'd be investing in, or what? How would you back into that essentially?
Great. I'm going to share my screen very quickly. All right. Can you see this?
Yes.
All right. So this is a very simple tool that I share with our prospective clients, and that individual can enter their federal tax liability, and then this makes some calculations for them. So in this
Okay.
scenario, right, if you have $1 million of tax liability, I calculate that your investment is going to be about 877. But
Okay.
usually this can even be less.
Okay.
So let's say it's about you you invest $812,000, right? For that, and you see that down here on this ledger. So there's an investment of 812 that returns $650,000 of tax credits.
Hmm.
Right. And you may say, Adam, I thought I'm getting $1 million of tax credits. Well, the total tax benefit package is a combination of credits plus depreciation. And the
Right.
big, beautiful bill accelerated what was currently a 40% accelerated depreciation in year one to
Hmm.
100%.
Yes, back to
So
100% bonus, which, by the way, again,
crazy.
we're talking about this all the time with real estate and all investing, but
Right,
does
right.
apply in this situation as well. So that's huge.
So this individual would receive $650,000 of dollar for dollar tax credits.
Okay.
They can claim $975,000 of federal tax depreciation, which of course then has a value. You multiply that by, call it 37% or 21 if you're a corporation. So that comes out to about 360 in effective cash.
Okay.
And then depending on your state, there may be state depreciation. I used 5% here, which is Illinois, but let's say this is New York or California. Obviously, the value of the state depreciation will increase proportionately.
Hmm. Yep.
So but the state depreciation is not 100% in year one. So we follow a
Right.
maker schedule. So
Hmm.
there's 20%, 32, so on and so forth for 6 years. This is the state depreciation value that the individual would receive.
Yeah.
There is always a small cash preferred payment on a quarterly basis that the
Okay.
investor receives for 5 years. And then typically at the end of 5 years, that investor can choose to remain in the vehicle and receive 5% of all the cash flows that
Okay.
originate from the sale of the solar power, or
Huh.
they can choose to be bought out and exit the asset holding company. In this case,
Okay.
I modeled a buyout, which comes out to somewhere around 7 or 8% after 5 years. And I
Seven
add
or
up
8% of your original investment.
that's right, sorry, right, of
Okay.
your that's right. So I multiply here 8% times G3, which was the investment,
Yeah.
gets us to 65K. It really is a net
Okay.
present view calculation, but
Yeah.
since that's 5 years out, I know that it will typically compute to 8 or 9%,
Okay.
right? So that,
What is I can't see the numbers, and for
oh,
listeners if they can't see the screen, what's the cash amount, or I guess distributions you're paying? I understand it's kind of a small amount, but what did you say that number is?
it's a 2% distribution. Typically it's
Okay.
2% flat and then
Mhm.
another 1% of the gross, which comes out to
Okay.
maybe 3% ish.
Okay.
But
Okay.
after we add the tax credits plus
Mhm.
the depreciation plus that little bit of cash pref on an after tax
Mhm.
basis, the year one tax mitigation will be about 28x. But this is an example that you and I put together, right? It won't
Mhm.
always be that,
Right.
but I expect this to be somewhere from 1.15x to 1.25. So in
Well.
this case, person made an investment of 812 or
Mhm.
$812,000 and that
Mhm.
returned, 1.03 in after tax benefit.
Okay.
And part of the
So,
additional benefit is that,
cash in terms of tax savings,
yes,
correct?
because the
Okay.
purpose of the investment vehicle is
Mhm.
not cash. It
Yeah.
is the tax benefit.
Right.
So I think of this all as the tax equivalent benefit.
Yes. Okay.
And
Understood.
as the user remains in the vehicle for at least 5 years, they have to remain in for 5 years.
Mhm.
They continue to accrue value in the form of cash and state depreciation if they're eligible.
Okay. Okay.
And I'm happy to send
Okay.
this to you, plus an executive summary, and you can share it with your listeners, and they can play around with the spreadsheet.
Yeah, perfect. I love that. I mean, it's a great exercise. It's a great tool to be able to pencil some numbers. So I do like that. So a couple of the most important closing questions. Number one, has the IRS like these? What is the situation with any scrutiny under audit or with this structure? Have you dealt with any issues and how has that been handled?
We haven't encountered any issues ourselves.
Hmm.
The IRS could choose to audit the tax account.
Hmm.
So we prepare for that. We use the top level accounting teams, obviously, and the attorneys. We've structured this in anticipation of an audit, And
Mm,
if an IRS agent were to ask questions, that there is a digital audit trail and that all the paperwork is in order.
mhm,
To the extent that um, this would be disallowed, well, tax equity is a $30 billion industry per year.
mhm,
It is the primary source of financing for the entire renewable energy industry. JP Morgan and Bank of America represent 50% of the industry, with Morgan Stanley, Goldman Sachs, and others at the long tail. We
mhm.
choose to specialize in the true long tail, which are residential portfolios and high net worth individuals. But this market has been around for, it is battle tested, is what I'm trying to express. It's been around for
Yep.
decades. Again, it emanated from real estate. The Inflation Reduction Act made this more accessible for individuals. And
Mhm.
then the Big Beautiful Bill it eliminated some of the edge cases and it solidified other use cases.
Got it. Yeah. Well, and then the bonus depreciation. So you've got that full depreciation back on that. And did retain. I was really curious if they were going to get rid. They did close a lot of opportunities with some of the energy incentives. Some of the ones that we actually have worked in for many years are closing as of 2026.
Right. At
So
the
it's
end of the
pretty
year.
interesting. Yeah. But yeah, it's interesting that this has been retained.
The interesting piece of the bonus depreciation is with 100% property depreciation in year one, that means the
Hmm.
federal depreciation, it actually behaves tax credit like. The tax credit is worth dollar for dollar offset. And now you have the depreciation is no longer being depreciated over 6 years. You can think of that as since it's an immediate deduction or it's an immediate
Yeah.
offset, it effectively behaves as in tax credit dynamics.
Yeah. Right.
So
Yeah.
anyway, coming back
So
to
interesting. Yeah.
the very beginning, when we started, we said, what is the problem we're trying to solve?
Yep.
Right. And it's not necessarily, is this a good investment?
Hmm.
Like, are we competing against the S&P 500 or Bitcoin or, is this an alternative asset that belongs in my portfolio with a private wealth manager? Right. That's a different, that's a different question, I think, which
Yep.
is I now
I agree.
have disposable income and I'm going to put it into some risk asset where I'm taking risk and I receive a return. And then, by the way, I need to pay capital gains on that return. So
Yep.
I take S&P 500 risk and then, market beta risk. I earn 7 or 8%. And now I'm paying tax on that, or I'm paying tax
Yep.
on interest for these bonds that I own. Really, what do you want to call it? The Hippocratic oath of wealth preservation should be tax mitigation. Just don't overpay the IRS. And
Yep.
this structure, that's the problem that we're solving, right? How to not overpay and how not to be too aggressive either,
Hmm.
right?
Hmm.
So, what
Right.
are some conservative strategies for not overpaying our tax burden? And then the remaining, the remaining disposable income. Then, what type of assets do we want to truly invest in?
Yeah. Well, it's a huge point because the whole like our focus, and I like to bring this up. I made a post the other day about how the IRS actually just posted a thing that there were $163 million in penalties assessed against investors or taxpayers who had utilized tax strategies they saw on social media. It's a thing, right? It's become a huge industry, and you've got all of these, TikTokers and Instagrammers and all these videos of, write off this and deduct that and do all of these things. I think it's so important to exactly what you're saying, differentiate between what am I investing in for wealth growth and for my portfolio growth and for my family's future versus tax equity or tax mitigation in terms of those types of investments. And I've said this before, I'll say it again. The IRS has incentives in play for people who are willing to put money into specific things. They're saying, look, if you give us the money to the IRS, we're going to invest in roads and bridges and schools
Yes,
and
right.
those. If you want to
Yeah,
invest in solar panels, you know what? You can do that. It's fine. We'll use this other money for the roads, the bridges, and the schools.
correct.
So I think that's the important differentiation and kind of trying to sort of simplify this. It's not that it is a way to get out of paying the IRS, or where it's like, hey, I want a loophole or I want a trick because I don't want to pay that. This is investing in infrastructure that is a benefit to society in a way that is actually aiding our communities. And typically, renewable energy, same with when we look at real estate investing, is putting dollars into our local communities, which is jobs, which is sales tax, which is property tax, which is all of these other things that are generating tax at other levels. So that is why these things also exist, to simply choose, would you like to allow the IRS to invest your money for you in roads and bridges and those things, or do you want to invest your own money in what other vehicles? So
Actually, if they were just doing roads and bridges, I'd support them more strongly.
yeah,
Only roads and
yeah,
bridges.
very true.
But I agree with that. It's so rare, not only in finance, but in most walks of life, where you truly have mutually beneficial outcomes. That the
Hmm.
outcomes are covariant, right? There are
Yeah,
win-wins. In
yeah,
financial markets, you typically have a fixed pie, which creates this zero-sum mentality. If I'm gaining, someone else is losing, and vice versa. This is an odd, kind of like a hopeful structure where it is truly a win-win. An individual taxpayer is benefiting by reducing their tax liability by building solar in someone else's community
yep, yep,
or in their own community. But typically the projects are being built in places where the sun shines, right?
yeah,
Not in Vermont, but
absolutely. Well,
or
places we want
Minnesota.
to do site visits. I mean, I hope that
Right.
it's
Yeah. Right.
down
Exactly. During the winter
on the
time.
coast and in Southern
Yeah. Yeah.
California.
That's
We'll need
exactly.
to
That's
talk about
exactly
that,
right.
Adam.
Yeah. So it
All
really is
right.
an integrative. It is a win-win. It's a
Yep.
win-win for all the parties involved, and that's why coming back to my own origin story, when I
Hmm.
discovered it, and then I verified that it was real because I saw Bank of America and JP Morgan doing 15-20 billion dollars of this each year. That was that was my moment where I realized that I wanted to get involved, and I didn't understand why it was
Mm.
not offered to individual tax accounts. And that is typically because it, to do it at scale and not in a bespoke way, it requires significant upfront work with
Mhm.
accountants and attorneys to structure. But through
You
some
know,
digital technology platform, we
mhm.
figured out a way to scale it and still do so responsibly.
Amazing. That is exactly how we built engineered tax services. It was
Yeah.
the exact same concept. Julio founded this coming out of a big four firm, seeing the big fours, the Price Waterhouse and the EYs and these huge companies giving these, and making it possible for these Fortune 100 companies to capture massive tax incentives and credits and deductions and strategies to reduce income tax that were not applicable or available for small to mid-sized taxpayers, just regular people.
Yeah, of
Because
course,
to
of
your
course.
point, all of the upfront work and the legal work and the analysis and all of that was so complex and convoluted, it just was not within grasp unless it was a massive entity. So it really is beautiful what you've been able to build and evolve into a way that it is more achievable for an accredited investor and other regular investors aside from massive family offices and corporations. And I do really want to also pinpoint the fact that I personally have seen some of these massive banks and massive corporations in this country who buy hundreds of millions of dollars of these renewable energy credits for sustainability and for the credits in those entities themselves. So I'm appreciative you brought that up because from a safe standpoint, from IRS scrutiny standpoint, I think it is important to understand that this is not a strategy that's not extremely common or commonly applied at very large scale as well.
That's right. Oh, the largest buy, I mean, 90% of all credits, perhaps even more, will be purchased by Fortune 100 and Fortune 500 companies. And the
Mm,
banks are by far the largest purchasers of these credits and
yeah.
sponsors of the tax equity. So we're not talking about some of those more exotic strategies like sponsoring a Siberian tiger to live in a Texas endangered farm or historic papers that sit in a file cabinet somewhere. And I'm
Yeah.
not criticizing, but I don't know. I don't know about like saving peacocks for tax purposes. This is a very different structure that
Yeah.
is pervasive within the
Hmm.
Fortune 100, 500, and many high net worth
Yeah.
accounts.
Well, amazing. Well, I appreciate the time. I appreciate you digging into this. It is complicated for listeners. We kind of went, up and down and all the way around to get to kind of the meat of how this functions. I hope you hung with us throughout this whole podcast episode, because in the end, it is complicated. But I liken this to the medical space. If you are your own advocate and you choose to educate yourself, the opportunities that are available for your own financial growth and for your family's future can be really significant when we understand how these things can
Right.
apply. So, well,
I fully agree. I fully agree.
thank
If
you.
people can just
Yeah,
suspend the disbelief of, oh, I'm getting this for free, so there must be a catch,
yeah,
and take the time to learn about it, you realize that this is a verified, decades old structure that is robust.
amazing. Yeah.
And we recorded this podcast on the first take,
Yes,
the whole thing.
absolutely. Well, Adam, thank you so
Well, thank
much.
you
I
so much for
really
having me.
appreciate your time. It's been great. This is a wrap for the episode of the Slash Tax Podcast. A huge thank you to Adam for sharing how renewable energy tax credits creates a powerful win-win and slashing taxes while investing in the future of clean energy as well. If you're a high income earner, you're a accredited investor, and you're curious about how to participate in solar or renewable tax credit opportunities, check out the show notes. We'll have contact information there. You can feel free to reach out to me directly as well. And thank you to our sponsor, Engineered Tax Services, the nation's leader in specialty tax incentives and strategies. Don't forget, please subscribe. We would love it if you would leave a review and share this podcast with anyone you know who may be interested or ready to combat smart investing with tax savings.